it's ambition. Okay. You want to make 1 million, you want to make 5 million, you want to be a landlord, you want to acquire property. That's wonderful. I love that. That's a wonderful place to be. I started this firm with blind ambition, no real knowledge and understanding emotionally of what it takes to be a real player.
Is your daily real estate syndication show. I'm your host, Whitney. So we are back again today with our guest, Chris Okada. And man, we're going to talk about the market cycles, right? He's been in this business a long time. You're going to hear so many nuggets of wisdom today about that market cycle, whether you survived one or not, or whether this is your first downturn. You're going to learn a lot. If you can just implement one or two things that Chris mentions today, you're going to be a multimillionaire most likely within the next few years, within the next 5 to 10 years, probably for sure. It's honored to have you back for another segment. The listeners, I want to remind them actually go back and listen to yesterday's episode if they didn't already, and you hear a lot of Chris's background. But man, you hear so much just knowledge and experience coming from many years in this industry, but also in a space where there's so many questions right now, even in a market where there's so many questions. I mean, he is the market and asset class expert in office and in New York City. We're diving into a number of things. So listen to yesterday's episode, and we're going to keep going with the conversation today, and we're going to keep learning from him about just different market cycles, things he's learned. Chris, looking forward to the conversation. Welcome back.
Thank you, Whitney. Thank you for having me. Hello, everyone. Let's jump right in
Let's do it.
and let me know what you need to, what you find valuable.
Yeah, no, awesome, Chris. Again, I appreciate even just yesterday's conversation. So many things I just feel like you hit on were perfect timing. But I wanted to continue the conversation. You and I briefly talked even before recording about this market cycle and things. Man, if you didn't live through a downturn, it's hard to think that's ever going to happen, right? It's just all
Yeah.
roses. It's all going up and up and to the left or to the right, I
Yeah.
should say, right? But so it's hard to maybe be prepared for that. And I want to just let's dive into that a little bit and financial problems that we should be anticipating, right? As we're real estate investors and operators, and as you've seen, and just through the real estate cycle.
Yeah. I think the scariest thing, and there's fear and then there's courage. Okay. Just very basic human emotions, fear, and then there's courage. The courage when you're young is blind. It's ambition. Okay. You want to make 1 million, you want to make 5 million, you want to be a landlord, you want to acquire property. That's wonderful. I love that. That's a wonderful place to be. I started this firm with blind ambition, no real knowledge and understanding emotionally of what it takes to be a real player. A real player in New York City is someone that is, if you're a broker, able to do several $billion of sales transactions, and a player has to be hundreds of millions of properties owned. That doesn't mean you're a 100 millionaire, but that means you are a player if you acquired and created a pool of 100 million, which is pretty much one building in New York City at this point. However, yeah, so every single decade, and you guys have to know the economic cycle is on average anywhere from 7 to 10 years. You got to look at the peaks and the valleys of your market and of the United States in general. You have to know that when the market is at the peak, money is easier to access, but deals make less sense. Let me repeat that. When the market is on fire, there's a lot of money. Banks are flush. They're willing to lend. Credit cards are increasing their limits. Investors are more around, but the deals are not good deals necessarily. When the market starts crashing and it comes down, and it's every decade, You have to be aware that it will come down. And that's why this market taught me, because I was all the way up in the financial crisis. I had no assets. I was just a broker making deals, and from, let's just say, 2010, which was kind of the bottom here in New York City and around the country in Phoenix, it was like 2013. So you have to know your micro economics as well as your macro. It was a straight shot, 10 years straight up and to the right, like you were saying. And 10 years is a long time, especially if you're young. 10 years. And if you, let's just say, started and you've experienced really upward momentum, things getting crazy, things getting expensive, and it just was a straight shot up, you get used to that. That's what you think. You don't understand. However, Warren Buffett, and I'm sure you all listen and watch him and learn from him, but Warren Buffett really, if you watch his moves, he was hoarding cash through 2015, 16, 17, 18, 19, 20. And he was actually yelled at by shareholders for not reaching ROI hurdles, annual hurdles, and yelled at for not investing. Why are you holding on to our cash? Why are you not deploying it? And in 23, he had spent hundreds of billions of dollars increasing holdings in Apple, increasing in all of his, and today has over $150 billion in cash. What does that mean? When the REITs started crashing, the real estate investment trusts that are publicly traded here in New York City, during the pandemic, I really started looking at the real estate investment trusts, how much cash they held. Then the regional bank crisis that happened, SVB. And why is JP Morgan constantly the one bailing people out? And I realized that they have anywhere from 35 to 50% of their assets in cash.
Mm.
Warren Buffett, $150 billion in cash. And then I looked at my real estate portfolio, and real estate owners have a very tough and slim level of cash holdings compared to their portfolio. If you have $100 million portfolio, of which 70% is debt and 30% is cash, you have to look at your debt obligations. And you have to say, and this is all brand new, and let's say you have $70 million in debt obligations. How much of that outside of equity is held in cash? A lot of operators and a lot of real estate investment trusts that are very smart have 5%, 10% of their entire portfolio. So that was a huge eye opener where I was like, oh my God, if things were to go south, you would be wiped out very fast. And as most of us are, we don't have necessarily a rich uncle that wrote us a $20 million check. We have to go out and syndicate deals, create pools of capital. But what we fail to also ultimately remind ourselves is that every decade you will experience this. If you're in your 20s, you're experiencing it. You're going to experience it in your 30s, you're going to experience it in your 40s, your 50s and 60s and 70s. You will have a credit event every single decade of your life. It
It's
may
kind of
be,
crazy how surprised we are when it happens.
we're always surprised. So here's a really tough thing to create for yourself. 12 to 24 months Every single mortgage that you have, you can carry it for 12 to 24 months with zero income. That is what JP Morgan and Warren Buffett essentially do. The distributions for us we were like, all right, we would have 3 to 6 months of just in case rainy day, all the more of mortgages and all the things. But 3 months is, as we learned, can go very quick if it gets bad. I never understood that. I have mentors in their 70s that told me, Chris, you have to time it. Be careful. We don't know about the pandemic, blah, blah, blah. But I went in head first, and I'm still learning to listen to the elders that are much wiser and wealthier than me, because you have to listen. But what we do when we're young, and I still do in my 40s, is, oh no, yeah, I hear you. I hear the risk. I hear it. Okay, Warren Buffett, great. Be fearful when everyone's greedy, when everyone's fearful. Great, wonderful. Let me buy some Bitcoin. It's on fire. I'm gonna 10x. So it's really challenging to hack your mentality to be on the conservative side at the same time want to grow aggressively. It's
Yeah.
very hard to do that. But here are the ratios. 25 to 50%, depending on how conservative you want to be. And it's very challenging to do this. And this is why it's hard. Liquid cash. If you're like, I'm worth 10 million bucks, but you only have $500,000 liquid, you gotta do whatever it takes to get that to 3 million bucks liquid.
So you're saying your overall your portfolio as an operator, or you mean personally, or how do you
Your
see that?
world, your world, your person, Whitney's world. I'm worth 10 million bucks. Here's how I don't know. I'm just making I don't know if you're worth 10 million bucks, but let's say you're worth 10 million bucks, 100 million bucks. How much of that is sitting in treasuries, in a liquefiable IRA, in the stock market? Because what we real estate people do is we tend to go all illiquid.
Yeah.
Now here, all of a sudden, we we had a personal event. Now we need $500,000, 100 grand, 250 grand, whatever it may be, surgery. All of a sudden, bam, 50 grand. And now our cash position is slashed in half or a third because we didn't realize, wow, we I need to increase all holdings significantly. The liquid portion of all of my assets, you know, you may not have as you may not hit your IRR hurdles that you promised, but guess what? We have cash. And what Warren Buffett does and what JP Morgan does is they wait for credit events. And so JP Morgan Chase, 35% cash. You could go online, JPM, that's the stock ticker, look at their balance sheet. I think it was something like 35% or 40% cash or liquefiable assets. They purchased 150, was it 100? They purchased First Republic Bank deposits for 5 cents on the dollar,
Oh, wow.
a 95% discount. I think $150 billion they paid something like $10 billion for. Warren Buffett, Apple crashed last year, doubled up. Now it's you wait, make a move. Wait, make a move. But all in a long time, you got to keep humming and churning. Now, JPM was also at risk of JP Morgan was also at risk of going under in '09. But they SVB, their portfolio is around. Everyone's dumping these pools of commercial mortgages that are underwater. So it's hard to do because we don't have $1 trillion in assets.
Right.
Okay. But we don't. Let's say you have, you, you want to get to $1 million of net worth. Okay. You only have 100 grand. Fine. But you got to be able to build these cash streams. And I don't know how you do that. For us, it's we sell and lease commercial real estate. We're real estate agents. Get really freaking good at that, and then hoard. Get to a certain amount, $1 million, 500,000. My numbers are a little skewed because
Sure.
Manhattan real estate is different. But you gotta better to have 100. Better have $1 million liquid and be a 2 millionaire than a 10 millionaire with a deca millionaire with $1 million liquid.
Yeah,
Um,
that
you'll
makes a ton of sense. It's being disciplined, isn't it? Like having a
so hard.
plan and being disciplined, it is so hard. It is so hard. I think back, man, if I could have thought through some of this 15 years ago, right, I'd been disciplined enough to have even done some of the things you're talking about. It is, but like you even mentioned too, looking at those, like you called our elders, right? Even looking at what people like Warren Buffett or JP Morgan are doing, it's like they're, it's not like they're brand new to this. This is not their first market cycle, right? And so not, many of us, it is our first blizzard, right?
Yeah.
And so we don't think that way yet, right? And it's unfortunate. It seems sometimes it takes a blizzard to help us to be disciplined for the next one.
Yeah, I'm telling you, I have so many lessons. I created a document about all the lessons I've learned during this monetary tightening market. And let me share some of them with you.
Yeah.
And these could be very uh commonsensical, but when the market's hot and when
Common
things
sense kind of goes out the window at that time, right?
it really does. It really does. Okay, number one, here we go. Think about acquisition criteria thoroughly about how the world is looking and working. Don't just jump into saying, I want to own apartments. Don't just jump in and say, I want to own a hotel. Don't just do things because you want to. Have a real acquisition criteria and use data, the internet, chat GPT, Google, to create an acquisition criteria based on reason.
Helping you
So
keep emotion out of it, right?
it's a reason, it's an investment thesis. When I was young, I just said, I want to own a building. I want to own a building. Why? I don't know. I just want to. Okay, that's fine. That's blind ambition. But create an acquisition criteria based on how the world is looking and working. If you're going to go and be a contrarian investor and saying, I'm going to go the opposite way, I'm going to go into office, you better have real data on why, not just that's what I want to do. Number two, during times of monetary tightening, everything gets expensive. Liquidity is drained. And if you're on the wrong side of this, you will suffer and potentially lose everything. Keyword, everything in that sentence. Now, there's a saying that if you haven't lost a game, you haven't been in the game. LeBron James, Michael Jordan, everyone, you lose. Okay. There are people that go unscathed. However, Warren Buffett says, never lose money. Right. So you just got to be smart about that. And key here is monetary tightening. Pay attention. We all knew that Jerome Powell in March of 22 and the Fed, we knew it was coming. Did we take immediate action? Did we learn about monetary tightening? We heard about it. We read it. We learned about it. We went on Google. Maybe we did slight studies, but we have to be aware. So now I know in times of monetary easing, it's a great time to buy, and or assets will go up in price. But if you're on the wrong side of this, everything gets expensive. Number three, construction will take 25% more money and 25% more time at best.
At best, that's for sure.
At best. Okay. How does it look if you're in a two-year project and now you're in year 3.5? Oh no. Okay. If you want to continue the project, still do it. Raise 100% of the money for those cost and time overruns. Sensitivity studies are important, meaning what if the apartments don't rent for $5,000 a month? What if it's $4,000? What if it's $3,000? Sensitivity studies. What if the market requires a 6.5%? All of my projections from 2010 on the exit were 4% exit on the capitalization rate. Now the market is requiring a 6% minimum in prime Manhattan. That's a 50% increase in what investors are looking for them to part with $1 million today. Debt is the killer, literally the killer of all businesses. Use it very cautiously, use it very wisely. When times go, 70% LTV, let me take a senior loan, a bridge loan, mezz loan. But debt is the killer. Better you have one property that's $1 million with 50% leverage at today's high rates, and you're clipping a coupon and it's boring, versus $10 million in property at 80% LTV with low rates. So you'll win. Invest in businesses and properties that have a moat. So in New York City, we specialize in Class C and Class B offices, not the shiny, gleamy glass towers. The properties that are just like 123 West 22 Street. No one knows about them. It doesn't matter. They're just millions and millions of square feet. Truly think about going after higher quality assets. They may be a little bit more expensive. They may be a little bit newer. The ROI potential, the equity multiple potential may be less. But in this market, in this lesson, the well-positioned properties remained well. They really did. Let me think. I have other things.
Well, I just, even what you said there about debt is a killer of all businesses. And I just think back about, man, how debt it is. I mean, it's biblical, right? The
Yeah.
borrower will be servant to the lender. And I
Yeah.
mean, it is so true. And especially in our market right now where lenders are calling, right? And man, loans that, I mean, I know so many operators who bought deals over the last, say, 18 months, 12 to 18 months, and don't even have a cap on a floating rate debt. And it's like, they're in trouble, right? And massive trouble. And that debt it's going to kill them, right? It's going to kill their business ultimately. And so I just think it's so wise, man, handle it with caution, right? And so much of our
Yeah.
business is done with debt, but man, you got to be cautious. I think it goes back to you talking about having, what'd you say? You said be able to carry the mortgage for 12 to 24 months. And would you say have 25%, 25 to 50%, I think you said, of your net worth, right, in cash?
It's
Man, that,
very hard to do
yeah, it is
because
hard to
in
do.
order for us to grow, we need leverage.
Right.
We need those wins where we bought a property, we put down $2 million, we borrowed $8 million. And it grew to $12 million. Now you have a 2x versus putting up $2 million, buying a $4 million property, and it maybe grew to 4.8, you know? And so, but the boring, slow stuff survives.
No doubt about it.
It's wild. And then the other things are things that I did right, and other things like your operating. Now, are most of your listeners, are they're syndicators? They raise capital? Are they growing? I'm going to assume that a lot of them need to raise money somehow, some way.
They are. There's many operators that listen who they're all syndicating, they're raising money. Many passive investors listen as well, who are the investors on the
Yeah.
other side of that.
Yep. So the operating agreement, don't go cheap on that. Don't go online. You're going to have to spend 5-10 grand on a good attorney that will be like, oh, this may be a pitfall. Now, both for LPs and GPs, passive investors and the general partners. Don't go cheap on that. Next, your reporting. Your reports should be on par with your bank reports. You get a bank statement notification from Bank of America that your statement's ready. So should your reports be on par. That's all of these things are not necessarily easy, but they are things that you should strive for. When you sign up a Bank of America document for a new checking account, it's accessible. You get your monthly statements. These are just some basic things that we need to improve. Okay. Things that we did right. Marketing. Go viral. It's the same thing. It's the same. How can we get the word out? That's something we did right. It takes a long time. Post after post. 1,600 podcasts, 1,700 podcasts, 1,800. There's beauty in that. And that's discipline. And all of a sudden, in podcast number 1,825, some guy in Saudi Arabia saw that you did something that they liked, and they happen to be in the area, and now they want to just have a meeting with you. I don't know, but we did something. We hired a PR agent, and this was last year in 22, and we had 800 million impressions on a piece of content that just went viral. And it started with the New York Times article. Okay. You got to think about getting the word out when you get to that level. And
That's
then
impressive that you all hired a PR firm and it was that successful. That's incredible. For you.
we've hired many PR companies just to do deal reporting, and we closed this deal. Congratulate us, pat on the back, get me in this newspaper. A lot of times it's a couple thousand views, maybe 10,000, 20,000 views. Our social media ranges from a few hundred views to hundreds of thousands, but we've never gone really truly viral. We've gone viral for like capturing crime, putting it on people like crime, celebrity, stuff like that, and crime TV stuff, but never real estate. It doesn't really go out there unless there's an angle. But yeah, I mean, we hit it with this PR team, but we've never hit those numbers ever again. We're back to the thousands of impressions, not hundreds of millions.
Chris,
Uh,
any other thoughts around what we're talking about now before we move to a few final questions? I appreciate your time. You've been so generous, but anything
yeah,
else on just this thought before we move to a
yes.
few final things?
One very important thing is teamwork. Everything is teamwork. I have a dream. When I was 19, I wanted to own a building in Manhattan. It didn't have to be anything special. I just wanted to build. Now I going through what we've gone through, I still have the ambition of wanting to create a glass tower. Okay. So now this market showed me the importance of your finance team, your general contracting team, your lender, your investors,
Property
and
management.
your property manager and your capabilities. It's okay to say, I would like to take on a gut rehab project. It's okay to say that. If you're going to do that, start off small with 1,000 square foot home. But if and when, and a lot of your listeners are going to want to grow and say, you know what, I want a 300,000 square foot multifamily complex with a pool and garage and some retail. All right. Don't think that you can do this if you've been doing 2,000 square foot homes. If the jump does not work, you can still do it, but you got to have the general contractor, the owner's rep, with people that you've interviewed and you've either heard of or had experience with. You got to have teams that are the A team. Okay. And the weakest link hurts the project. If it's on the property management side, and again, A teams want A dollars. For those of you that have been in the industry for over 10, 15 years, you, you want to cut the crap. You're not working with crappy little clients. You don't have time to deal with. Same thing with general contractors. They don't want crappy little cheap clients. Same with the banks. They're going to require an attorney that will cost $80,000. And you're like, well, you have your own legal team, have your own your property. A real property manager will be like, we're not doing this for 2% on the gross income. We need 5. And here's why. Or we need 6. And then at some point you're like, all right, hold on.
Right.
And when we're growing, we tend to want to cut corners as far as budget. But when you really go for it and you really need an A team, and what is the A team? The A architect. I piecemeal the project with the cheapest architect or the guy that is emerging and up and coming, when it should have been the architect that had a price tag that was 6 figures versus $10,000 or $20,000. I should have gone with them from the start. I should have hired we did the GC project. We interviewed 4 general contractors. We went with the cheapest guy. There were delays. They change orders. They're working with us. There was always 1 or 2 guys on site when they should have had 5, 6. Go for the A team. Now, that's
How many
not
times
saying
do we have to learn that lesson?
I cut corners on legal, got me in a little weird situation because it was the cheapest lawyer,
Yeah.
$2,000. Next, my next project, I'm doing a $28-30 million project. My next project, from what I learned now, might as well go bigger. But if I'm going to lose my butt on a $10 million mortgage and it was going to wipe me out, why didn't I go for $100 million?
That's right.
Right? But this time now I know I need the best. I know I need good attorneys, good property managers, good GC, people that have a good reputation. and
It
then let's
almost goes back to some of our first conversation too. It's like you're gonna have blizzards, and when the blizzard comes, man, you want the A team, right?
yeah,
You want those relationships with the A team during that time as much as any.
yeah. So I think these are just things that I've learned. And for those of you out there that are younger, that are not, that don't have risk, it's really hard to not learn without going through it. But if you're able to take the lessons of this monetary tightening environment and hold it for the next 40 years, you will save yourself a lot of pain. And so now I'm listening to the elders. Now I'm going to not jump right in. Now I'm going to wait to see what this market gives. I'm going to see how far the monetary, if I didn't buy a single property from 2021, if I didn't do the last two deals, I would be in a better monetary position. One, I was a 2X, and then I put that into a larger project that is now more ambitious, but costs a lot more and causing trouble. So had I not had the 2X was a huge win inside of 12 months, but I learned a lot, so I don't know. And the end result, the end game is actually, 30, 40, like a long time from. That's really the report card. So we're still learning, we're still doing these things, but really take these lessons. And I'm sure, Whitney, I'm sure your listeners and you yourself, I'm sure, hear all kinds of things. The A team. We heard about, yeah, sure. Well, yeah, have 25% of my total net worth in cash. Sure. I'll get to there. But I got this great deal. I can really double up right now, but it's going to really bring me back down to 5% liquid, but I got to go for it.
Yeah.
Those are the tough decisions that we have to make. And the large firms have a board before any real money is made, before any decision is made. It goes through all of that. Unfortunately, as a lot of entrepreneurs are, the board is right here.
Right. As you just, yeah, keeping the emotion out of it. Right.
Yeah, being like, speak to your board could be your mom, your dad, your sister, your business partner, other people. And a lot of times they're going to say, sorry, Whitney. I mean, it's a great deal, but maybe we could do something a lot smaller. That's a lot
Yeah.
safer in line.
I
And
think
where
that's
we,
so wise to have a board. You're talking about the A team. I think even having a board of advisors that can speak into things like that, right? They may not even be on your, say, team or employed by you or
yeah,
part of your organization. But for me, mentors, right? We talk about it so often on the show, but even in this case, having a team of people like that you can bounce those things off of, like you said, that's been doing this for 20, 30, 40 years makes a massive difference. It has made, I mean, I can't even tell you how much it's probably saved me in tears, right?
yeah,
Just having those people that have been there and done that when I'm thinking, man, we should go do this thing. And like exactly what you're saying. And then they're like, oh, wait a minute. I've seen this before. And I'm like, oh,
yeah.
okay. Like, yeah, let's not do that thing. So, but Chris, we better move to a few final questions. I've kept you so long.
Sure,
So I'm
yeah.
grateful. And this just be kind of quick, a few things, but what's your best advice right now for passive investors?
I think for passive investors, you're in a wonderful position. That means that you do have capital to deploy. I would look at all different types of asset classes. If you are going to get into real estate, it's a wonderful time to look at things that are at a lower LTV as far as your debt equity ratio. It may cost you more, but the wonderful thing about this market is that your coupons have increased by 30 to 40%. I think that's really incredible. I think it's a wonderful time to look at your cash position if you're not ready to deploy just yet, to look at treasuries and money markets that are pumping out 5.5% while you wait. And I myself have started implementing that because that really helps. A couple, $500,000, you're bringing in $25,000 a year, tax free. Nothing wrong with that while you figure out your next move. I would be very cautious, and because we're still in this market, the monetary tightening environment is not finished. There is a risk. It's less than 50%, less than 60% of a double inflationary bounce over the next 12 months. I feel that, so just to be careful with that. At the same time, if you're interested in growing, just look at all asset classes and look at markets, because if it's too hot, it's probably going to be on its way down. The Miami story is still growing, but we're already seeing cracks in that story and that foundation as far as people canceling contracts, construction projects being put on hold. Rents are starting to come down a little bit because they grew 30%. So just be very careful with the hot thing, especially when it comes to the Sun Belt. Everyone's looking at the Sun Belt, which is fine. But just to let you know, interest rates are 6.5%. If you're looking at any project that is today cash flowing and it's prime, but the capitalization rate is under 6 to 6.5, I would be weary. I get emails every single day for a 5%, 5.5% cash flow, fully leased, beautiful property. Um, there are other things to look at. And for the general partners that are trying to raise capital, it's a very tough time to have investors part with $1 million or 5 million or even 100 grand because of their risk appetite. We raised in 21 when everyone was getting unemployment and the PPP and all that kinds of stuff. We raised something like 6-7 million bucks inside 60 days. We've been struggling to raise even half of that over the last 6 months.
Yeah.
So just to let you know that the capital markets are in a funk. And if you are sitting with a lot of liquidity, it's a great time to look at deals that are cash flowing, that are a little bit boring. No need to go into the whole venture, vulture fund, distressed, blood in the street. Like that all means that, I mean, there are incredible opportunities out there, but you don't need to go for the dying property that's bleeding out, because there's incredible ROI, and this is a long game. We
Yeah.
still have decades ahead of us. Even though this is my 21st year, I don't know what's the average. 65 today, 65 to 70, and we have decades ahead of us. So it's a long game, and so I think
What
that
are what are some of the most important metrics that you track?
absolutely, I'm very interested these days. Well, the KPIs for our leasing business, and then the investments are different. We need to grow significantly. We're up 42% year over year on commission income. So anyone that's a realtor out there that is struggling, you got to just double up, triple up. This is not the time to be going on boats and champagne parties. Unfortunately,
Yeah.
this is a time to really do work. To every deal counts, meaning that $1,000 is still $1,000. Don't poo it because y- you're used to making 100 grand a time. And now you got to work hard for 5 grand, work hard for 5 grand.
Yeah.
Uh, in this
It's that
market,
500 you were talking about that you got in 2020, right? That's
it's unbelievable.
other.
My largest sale as a broker, as an agent, was $217 million. My happiest moment in 2020 was $500.
Yeah.
So you got to take ego right out that equation. If you
Yeah.
got ego in this market, there's something wrong with you. You're not really a player, because everyone is stressed out right now.
Any,
But
any
yeah,
habits, Chris, that you are disciplined about that have produced the highest return for you?
yes, Saturdays work. Now, if you're in residential real estate, you're working 7 days, you're doing open houses anyway. But, that Saturday morning, if you start treating it, and a lot of people do not like to hear this, but if you treat Saturday morning like if it was a Wednesday morning and you broke at lunch, that extra 3, 4 hours in Saturday morning where you're working on the business, it really adds up.
Mm.
And I even got into the thing of Sunday afternoons, if I got a couple hours. Of course, it takes a little bit away from family time. So I look for the lulls where, you know, where everyone's running around and and it's a little bit of unbalance and I'm geared a little bit and I get a bunch of group chats with my college buddies and I'm doing an Airbnb sort of run because my wife is like, "Oh man, I'm burnt out. We need to do something this summer. It doesn't have to be expensive. We got to get out the house. Can we go somewhere?" I'm like, "Yeah, let me start looking up Airbnbs." And I start posting in the middle of upstate New York. How are homes getting $499 and they have no availability per night until November? What is and I go on this whole thing and a college buddy of mine is like, "What's wrong with you? It's 10:30 p.m. Go go hang out with your wife. Go hang out with your kids." So I'm a little bit obsessed with understanding cash flow streams. So get a little obsessed with studying different revenue streams and business models in the world of real estate. And it's fascinating. And if you could do that, just adding an extra 3 to 5 hours a week on the weekends to work on the business, not in the business, on the business. What are macro trends? What are some key hires I need to make? And finally, I started really looking into revenue per employee.
Mm.
If you're on a team, if you run a property management company, if you're a syndicating company and there's only 3 of you, if you're whatever it is, Apple computers, their one of their performance indicators is $1.2 million per employee. Okay.
Wow.
They're at the top. So, you know, a well-oiled machine should be in the $300,000 of revenue or rental income per employee. And don't think that rental income is not revenue. It is revenue. So we all tend to think of things differently. Rental income per employee, 300, 400,000. Okay. You got to be careful about bringing on, building a whole property management arm for your holdings. If it's too early, you'll suffocate because free up that time. And those are just some things that I'm starting to look at.
That's
Rev-
incredible advice, even right there. I wish we could even dive into that. Man, well, last question, Chris.
yeah.
How do you like to give back?
I'm a Sunday school teacher. I was on a different podcast and talking about why can I weather the storm? I'm a man of faith This is my 20th year uh, for the kids in Queens, New York. And my wife is like, well, it's been 20 years. You should, but I do give back by teaching Sunday school, taught thousands of kids, and I give back on social media. I try to, I've trained dozens and dozens of people in the world of real estate, and most of them are not with our firm. So lots of training, lots of optimism, lots of hope, lots of religion and spiritual lessons. And I have a vision, and I unveiled it to my team in December of 2022, talking about 23. I would like to make millionaires in my firm, and one per over the next 3-4 years. Um, January 1, 2028, I need to make 2 millionaires in my firm. And January 1st, 2028, I need to make someone a multimillionaire in my firm. Our shop is small. We only have 12 people. So there's got to be millionaires that have been made, and it's not necessarily a lot of money, a couple hundred grand a year. But at the very least, I need to bring in someone has made 500,000 a year consistently,
Yeah.
and then multiple people 250,000 a year every year.
Love that. Love your focus on giving back. Appreciate you sharing your faith as well. No doubt about it. I also appreciate your focus on even bettering your employees in that way. And I think even more so than say the salary or the income that you're able to help them or provide for them in that way through your business. But it's almost numerous of the things that you've just mentioned in this episode by itself, not to mention yesterday's episode, but just today's alone. There's numerous takeaways. I mean, if they would just internalize and apply a number of those things, they'll be a millionaire.
Yeah.
And debt being a killer, right? Or the boring is what survives. And it just so even the reserve component, a quarter of your net worth, liquid, and some of those things, man, you're going to give back to them in a massive way if you can just teach them some of those things and then implement a few of them. But Chris, pleasure to meet you and have you on the show
Thank you,
again.
Whitney.
Yeah, I'm grateful to have connected, and tell the listeners how they can get in touch with you, but also from Fear to Fortune, where they can find
Yeah,
articles.
definitely. Read this white paper and learn from it on how to make your own acquisition criteria based on data and information, which everyone has, the internet. From feartofortune.net is the white paper. And you could find me on all social media outlets at Chris Okada. The last name is Okada. And that's it. And you guys, for the listeners here in the United States, you got to find that fire. And for us, the American dream is a financial one. It is a spiritual one. I'm highly motivated, and you will lose reasons on why you got to climb the next mountain. Once you make $1 million, maybe it'll be your family. Okay, now the family's fine, and the kids are growing up, and school's taken care of. For me, the fire in the belly is now giving back and allowing others to live the American dream. And that really is one of financial freedom, freedom in general, but really financial. And the 1% mark, the 1% mark continues to increase because of inflation. So you guys, you gotta get, try to climb up even the 5% mark. And I urge you to do whatever you can and work real hard, because we have a problem with laziness. We really do. We have a problem. So to fulfill the American dream and to give your family the life that you deserve and the one they deserve, a lot of work, but Whitney's got incredible people on here. And he himself, if he can absorb 5% of the 17,000 podcasts, he'll be a billionaire uh, one day, hopefully. All right. Well, thanks a lot, guys. Find me at Chris Okada, And Whitney, thank you so much for having me, and take care, everyone.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.